Welcome to Taking Stock for the week ending 7th of February 2025, where Kien, Trinh, our head of stock doctor research, and myself, Tim Lincoln, stream to you all things share market. How are you, Kien?
Not too bad, Tim. It's the calm before the storm as we approach the busy period of reporting season. So there'll be a lot of work next week, but I'm looking forward to it with my team and talking to you about some of these stock changes.
You better kick back and have a relaxing weekend, betting you, because it certainly does get busy from Monday onwards, but can't wait, Kien. It's promises to be another really good, solid reporting season, I'm sure, or interesting at least. But
Mm.
before we get started, just a reminder that all the information we share today on taking stock is of general nature and therefore should not be construed as personal advice. And all of the data, information, performance metrics is also shown, all historical in nature, and therefore should not be relied upon as a guide for future performance. But Kien, the Aussie equity markets certainly had a terrific month in January again, supported by global markets as well. So the sun keeps shining on this wonderful asset class, and businesses like Pro Medicus just keep on producing too, don't they? Winning contracts left, right, and centre. Just quite incredible. But again, we just got to remain really disciplined with the management of our portfolios, take profits where profits can be taken to ensure we don't get overweight positions. But obviously, make hay while the sun is shining. So terrific start to the year for equity markets. But the start of this week, certainly, and the month of February, it got off to a rocky start, didn't it? With the Aussie market dipping around 1.8% at the start of the week, following news of the imposing tariff cuts in the US and 25% cuts on imports from Canada and Mexico and 10% from China. But as the week progressed, there was a sigh of relief from investors when President Trump announced a delay in tariffs on imports from Canada and Mexico. Meanwhile, despite China retaliating with its own tariffs on US goods, their moves seem relatively measured, allowing markets to recover. So again, that old yo-yo continues. The markets just want to keep going up, don't they? And as the focus shifted to earnings season, both here in the US, that really did fuel that more positive sentiment in equity markets. Over in the US, the fourth quarter reporting season has been very, very solid indeed, with about 77% of US companies posting solid and positive results and above market expectations. Lifting that optimism even more. The S&P 500 is now expected to see earnings growth of around 14% for this year. So the US economy is certainly still going full steam ahead, Kien.
Yeah, that's incredible growth given that they've grown last year as well. So continue to grow off a high base. But these positive surprises have largely come from the tech and also the financial sectors in the US, which continue to show that growth. And this could be a positive signal for our Australian earnings season too. You know, companies like Net Wealth, for instance, Hub24 have reported solid trading updates recently. And Tim, you mentioned Pro Medicus, that they announced another contract win of 53 million as well. And of course, we had our star stocks like ResMed and REA Group. They've also exceeded market expectations.
Yeah, incredible, isn't it? And speaking of the property classifieds business REA, Kien, who you just touched on and mentioned, let's kick things off with their recent first half 25 results. The share price reaction appears muted, therefore seeing it is a little bit muted. What stood out in regard to their announcement?
Yeah, REA Group, they delivered impressive growth across the board. Revenue was up about 20%, while profits, their net profits was up 26%. So very strong growth. And that bet market expectations by around 2%. And the key drivers of that were strong listing activity and higher ad prices, showing that vendors still have confidence in the market, Tim.
Yeah, so more transactions and increased pricing has reinforced REA's pricing power and strong market share. That real brand equity is incredibly strong still with them, isn't it? This is why it generates return on equity and net profit margins at the incredible rate of 30%, which is just amazing. But it wasn't just the financials that grabbed our attention. There's also a leadership change, Kim, with CEO Owen Wilson announcing his retirement.
Yeah, that's right, Tim. This is probably the reason why the share price reaction was quite muted, given the impressive financials. After 10 years at REA, including six as the CEO, Owen Wilson, he's decided to step down in the second half of 2025, and the board is already looking for a successor, both internally and externally. While this introduces a degree of transition risk, we don't think it will materially impact the business in the near term, Tim.
Yeah, it's all be interesting to watch that succession process take place and the whole recruitment and process because obviously Owen has done a sterling job over the 10 years. But as you said, you'd think that they will have a lot of rigor behind that process. The stock is currently under review, but REA looks likely to be retained as a star growth stock, which is great. Another company that reported this week was debts purchaser and collector Credit Corp Kien. Excellent to see them back under our microscope as well. Looking at them for potential inclusion again. The financial metrics look strong with return on equity at 11% and net profit margins at 17%. So really good, solid financials there under Golden Rule 2. Unfortunately, the results came in below market expectations though, and the stock took a 13% hit on the day. What's the key takeaway for you and the team on Credit Corp's result, Kien?
Yeah, currently we're reviewing this stock, Tim, and the US division, it seems to be continuing to struggle with the collection environment. They're still quite challenging. Additionally, you've got the Australian and New Zealand debt buying market that isn't showing signs of a recovery as well. And as a result, management have only reiterated their guidance for full year 25 rather than providing an upgrade as they usually do in the previous years. It's currently not a star stock, but we're assessing the active risks, particularly the impact to its earnings revisions, Tim. And we have placed the stock under review in the meantime as we assess the potential for it to be a star growth and star income stock. The gross dividend yield is currently at about 6.2%, but we want to ensure that that is sustainable.
All right, a potential star growth stock and star income stock inclusion, but more work for you and the team to be done there. So I can't wait to see what unfolds with Credit Corp. Of all the reports this week, Kien, one of the standout performers was BWP Trust, who is one of our star income stocks at the moment. Their earnings were really solid and they have a better outlook for the property sector. Kien, why should we be more positive on BWP and REITs in the year ahead?
Yeah, good question, Tim. And BWP and REITs, they seem to have reached a turning point in terms of their cash flow generation, Tim. Revenue growth has remained quite strong. Largely, that's driven by rising rents. And with the US cutting interest rates and the RBA potentially following suit as well this year, we expect the debt servicing costs to fall and portfolio revaluations to also improve as well, Tim. And BWP's first half results, they showed that it was the first upward revaluation of its property portfolio in years, Tim, and its average cost of debt also decreased. So it's good signs ahead for the sector.
Yeah, and being the owner of all of those Bunnings stores, Kien, it's a wonderful portfolio of really solid assets with obviously that income flowing through from the Bunnings Group and Wesfarmers, of course. And we need to remind investors that the rate cut isn't always a slam dunk for REITs either. You always got to be more vigilant than just that. Lower interest rates typically coincide with weaker business conditions, which could impact occupancy rates and future rent reviews for REITs. That said, BWP's 98.7% occupancy rate, because of mainly Bunnings and the Wesfarmers commitment, and 21.4% gearing level provide significant protection if the economy does weaken.
Yeah, that's right, Tim. And we also believe BWP's future dividends, they are sustainable as a result of that, thanks to their improving operating cash flows. And that's driven by growth in net property income and also lower interest expenses as that flows throughout the year as well, Tim. And BWP's is currently forecasting dividends to be around 19 cents per share this year. And that's in line with market expectations. And that's translating to a dividend yield of about 5.4%.
Incredible. So yeah, really good story there, Kien. And looking ahead, the reporting season is expected to pick up materially next week, hence why you're going to have a nice relaxing weekend with a few big names, including Breville, CSL, Commonwealth Bank, Cochlear, and Computershare, all set to announce next week. So please refer to the corporate calendar for a full list of all of those star stocks reporting. So you can really plan ahead for this reporting season and take advantage when the releases and the updates to financials are red hot. And now to Under the Microscope, Kien. And this week we're diving into respiratory care company ResMed. Been a ripper business for us for a long, long time, and one we love. The business has been delivering consistent results with a stable return on equity, as we can see under Golden Rule 2, of around 26% and net profit margins of 25%. Great solid numbers there. Its second quarter results were above market expectations, Kien. So just walk us through those a little bit.
Yeah, that's right, Tim. Revenue was up about 10% year on year, while earnings rose 29%. Incredible. And the company's strong performance was driven by their robust demand for their sleep and respiratory care devices, especially in the US market. We've seen that pick up as well. And this led to positive earnings revisions under Golden Rule 3, Tim, and a stronger growth outlook.
Okay, so now with all the noise around tariffs, Kien, especially President Trump's aggressive policies in the US, how might this active risking impact ResMed?
Yeah, despite concerns, Tim, from our perspective, ResMed is fairly well positioned. Unlike some competitors who rely on manufacturing in China or Mexico, ResMed's production facilities are actually spread across Sydney, Singapore, and the US. So if tariffs are imposed in these kind of countries, it's likely to hurt their competitors more than ResMed and potentially giving them a competitive edge and even improve their margins, Tim.
Yeah, and another major concern in the market recently has been the rise of weight loss drugs like Ozempic. Kien, are these drugs likely to have an impact on ResMed's business and economic model?
Yeah, that's been an ongoing concern over the last year or so, and that's created some volatility in the share price of ResMed. While weight loss drugs like Ozempic, they can reduce the severity of sleep apnea, they don't actually eliminate it, Tim. And ResMed CEO, he actually sees these drugs as a positive because they encourage more people to seek medical care, which in turn increases diagnosis rates. And also ultimately, this adds to the use of CPAP machines, which ResMed creates.
Yeah, that's a really interesting perspective, Kien.
Mm.
Now, what about valuation under Golden Rule 5? Does ResMed look overpriced at the moment to you, or should we still be prepared to pay a premium for this quality business?
Well, the stock, Tim, it's rallied by about 30% over the year. And so you'd think that it's overpriced at these levels, but the share price is currently trading at a slight discount based on consensus target price of around 11 analysts. So the analysts have been upgrading their earnings based on these earnings revisions. And it's also trading at a price to earnings multiple of around 25 times, which appears to be in line with their historical average. And the key risk, though, is how weight loss drugs could impact demand over time. So we'll be watching this very closely.
Yeah, that's excellent, Kien. Really good guidance there. Even though it's got a highish PE, the market still believes, or the covering analysts still believe, that they're trading at fair value. Excellent stuff. So overall, despite some potential risks, ResMed's solid financial performance, upgraded earnings outlook, and strategic positioning suggest it will remain resilient in the face of a challenging market and overall conditions. And now to question of the week, Kien. And with all the concern over US tariffs and their potential impact on the global economy, some of our members have been asking how these tariffs might affect our star stocks, Kien.
Yeah, Tim, it's quite a tricky question, and because there's so many moving parts with supply chains, currency impacts, and I think we'll just have to wait for company announcements to fully understand the impact. But in general, tariffs can lead to inflationary pressures, which could keep interest rates higher for longer, and that, of course, raises fears around corporate profitability in the equity markets. But at the stock level, a 10% US tax on Chinese goods, for instance, could weaken China's economy, and which is also Australia's largest trading partner. So this could reduce demand for Australian resources, leading to lower commodity prices. And that, of course, could affect resource stocks like Rio Tinto and Woodside Petroleum. On the industrial side, though, higher tariffs could disrupt companies that rely on the US supply chain, such as, for instance, CSL and Fisher and Paykel. Fisher and Paykel, for example, recently warned of higher costs and lower margins due to their reliance on manufacturing in Mexico and also sales into the US. But of course, there could also be opportunities here as well. If China retaliates with tariffs on US agricultural imports, then Australian companies like Treasury Wines could step in to fill the gap.
Interesting, Kien. And it's really clear, isn't it, that the impact of tariffs is complex and not something we can easily quantify. Rather than speculate and worry about the impact of tariffs, it's better to focus on the facts and the true fundamentals and true quality of companies, especially this reporting season as companies release their results. Keep an eye on financial health. Really, really important. Profit margins and earnings revisions. Make sure that companies are just keep on keeping on and able to absorb the impacts of tariffs. Stick to that bottom-up perspective. And if high-quality stocks drop on tariff fears, then that's obviously represents a great opportunity to buy great businesses at cheaper prices. So stick to that bottom-up approach, invest in quality companies, block out the noise and take advantage of any impact macroeconomic might have on quality businesses. All right, Kien, that's all we got time for now. You go away and have a great relaxing weekend and get those energy levels up, ready for a big reporting season.
Yeah, I know it's going to be very big, Tim. And of course, if you have any questions, if our members have any questions from today's episode, join us for our Lincoln Live on Monday next week. But again, focus on your portfolios this reporting season. There's going to be a lot of volatility, as you mentioned, Tim. So make sure you've got risk management techniques in process, and manage that volatility, be diversified and invest in those quality businesses.
Yeah, love our chats, Kien. Thanks a lot for your time today and can't wait to have a lot more stimulating conversations with you about companies as we smash into reporting season. So really exciting, can't wait. But as reporting season heats up, our members, it's really important for you to stay on top of your portfolios, be really well prepared and set your watch lists up on stocks you might be interested in bringing into your portfolios, set up your alerts, making sure that you're on top of companies, again, as they release the ones you own, so that you can make those really, really informed and quick and efficient decisions, and obviously to track any changes. But yeah, being really disciplined and proactive with the management of your portfolios now is really, really, really important in order to benefit from those decisions over the long term. Okay, so Kien, thanks a lot again. Take care, everyone, and have a happy, healthy, and prosperous week. Goodbye for now.